Bitcoin got body slammed by a whale-sized sell-off, reminding everyone that price goes down faster than it goes up. Meanwhile, Ken Carson's Summer of George rolls on as he meme jitsus his way through macro with the confidence of a man who's been to the future and has returned to warn the rest of us. All that and more on today's After Hours. Welcome to After Hours at Traders Post for Friday, July 25th, 2025. I'm one of your hosts, Tom Hartman, joined as ever by Peter Hartman, Exit Liquidity for Traders Post, to break down the market madness. After Hours is your go-to live streaming show for sharp, trader-focused market commentary presented by Traders Post, the ultimate automated trading platform in the universe. But more on that later. For now, I love to turn to my co-host and ask, how has your week been?
It's been interesting. Bitcoin, W2F, what's going on? 116, 114, 119. Where are we? This is like a will they, won't they, Ross and Rachel type situation. Explain.
Well, this is great. So we had, starting last week, there's rumors of, well, not just rumors, we saw on the blockchain 80,000 Bitcoin be transferred from an OG wallet back in the, I think, 2017 days or even earlier than that. 80,000 Bitcoin that got transferred to like Galaxy Digital and I forget where else, but other crypto platforms for presumably for sale. So on the 80,000 person made, I think they spent $32,000 for that Bitcoin when they first bought it, and they cleared $9 billion.
9.3, yeah.
So the question here is, that happened around the 14th, 15th, 16th or so. And there was some other selling from like Bitcoin miners and whatever. And so we had the sell-off that happened on the 14th and again a little bit over here on the 18th. But there's no way to know for sure, like if that's when the full 80,000 Bitcoin were sold. Because one, they're set in parts, and two, once they go into the exchanges, there could be deals done behind the scenes in order to give them a specific price, and then it can be sold, slowly through over time or all at once. But there's no accounting for, hey, has this actually been sold to the market? But we have to assume that part of that $9 billion that's funneled to whoever this person is accounts for the 6% drop that we've had in Bitcoin since the 14th, which to me is extremely exciting news. Why? Because if the 6-7% drop in Bitcoin over the last 2 weeks or so, if this accounts for the 80,000 Bitcoins that were sold, that means the bullishness of the market is so much so that you can sell 80,000 Bitcoin in 2 weeks and barely suffer a drop. It also points to the idea here that, hey, you ever ask yourself, what does $9 billion sale of Bitcoin look like on a chart? Well, this could be it. It could be a 7% drop. But this is what it looks like when $9 billion worth of Bitcoin is sold. You know what I mean? So it's like, okay, that's pretty interesting. So then what happens to the, let me go pull that up 1 second. Peter?
Yeah, sorry. I was looking at the chat. Hi, Venture Trader.
So what happens here when we take a look at the Bitcoin exchange liquidations? If we take a look at the 30-day, just getting an idea of the Binance, OKX, and Bybit together. You guys know I love looking at this. Where we're at $15 billion short now. We were at $7 billion or $8 billion short by the end of last week. Now we're up double that, almost double that, right? So if that $15 billion ever has to be sold, ever has to be liquidated, well, it has to be liquidated. It has to be covered, right? Whoever's short on the markets, you're going to have to, they're going to have to buy back that position, whether at a loss or in a profit, that also has to be bought back. But if they're forced to buy back, I would get a $15 billion short squeeze. well, then you can imagine that that is like nearly double of what we saw down over here, and that would bring us, let's call it, that would bring us in one fell swoop something like 130,000. Like that could happen like that,
Mm-hmm.
right? If those 15 billion shorts get liquidated, boom, it can happen in a squeeze. In fact, if we take a look at what's going on in the liquidation history, we're noticing here how, if we just take a look at BTC only, this is on CoinGlass, and let's just go to our recent time over here. You'll notice here that the longs, the amount of liquidations, these green candles that you're seeing, these green bars, are getting lower and lower and lower and lower. So the amount of longs getting liquidated are lower, which makes sense. Sure. Are getting lower, while the amount of red liquidations, short liquidations, are getting higher, right? And this makes sense. We're only seeing something like now, what, 700 million, 800 million levered long versus 15 billion levered short. So like the longs aren't getting in here to be liquidated. So that means the selling, when the price is moving up in Bitcoin, what this suggests is when these step changes are happening, these step changes like this, where it just violently moves up, that these are liquidations of shorts that are happening. But the sell-offs aren't liquidations of longs. They're profit taking. They are so it's not liquidations that are happening to the downside. Sometimes it is, but not to any giant degree. It means that the real buying is happening, and the shorts are getting liquidated. That step changes the price up higher and higher and higher. So the next time that we get a liquidation and step change higher, it means that we're not likely to pull back much lower, because the longs haven't levered long. It's only the shorts that are going to liquidate it, and then you get to a new equilibrium to where the price would have been were the shorts not there. So to me, that's very exciting, very great news. And look, the pattern of the chart is just totally normal. This is just a totally normal flag that can happen, and then we can have a breakout, which is usually as high as the pole that led up to that beforehand. So do I still think Bitcoin gets to 150 by the end of this month? Totally could be possible. Certainly by next month, I would imagine that can happen. And in our next segment afterwards, when we talk about Ken Carson, about what's going on there, what's going on in markets and sort of predictions and stuff like that, it also lends itself to the idea of a blow-off top for Bitcoin. Now, Peter, I know you're excited. I know that it's really exciting to you, this idea that I mean, you short Bitcoin. That's all you do, right? You just have a big short. You're one of the big whales, just holding on to billions of dollars of shorts, and you don't want my words to be true. I get it.
Okay.
Yeah. But this is the reality that you live in. Now, if we take a look a little bit further here, we're seeing that. Sorry, let me not just clutter the chart with too much too much insight. Too much insight. It might be a little bit too hard for some people. But if we take a look at the actually, let me remove that. Let's just add the M2. What we're seeing here is that this is coinciding. Let's move to the daily. This is coinciding with, at the bottom here, we have our liquidity that we've been taking a look at over the last period of whenever. So for some months now, and we're noticing here that we're getting a lower high on liquidity, right? This is speaking to a faltering of liquidity versus the standard move up that we saw before. Sure, it could be just a little dip before we get higher, but if this continues and this is a lower high and we're going to head lower, this suggests a pulling back of liquidity and a topping process for Bitcoin over the next couple of weeks, couple of months. So I still think it could very well be possible that come September, October, November, we're starting to get that peak, and then we roll over. What does that mean in the beforehand? That we could potentially have that blow off top that causes all these shorts to get liquidated, longs to come in some hype cycle to happen, all coins, all within a quarter period of time, it gets really high, higher than people can think, and then we crash down to where it needs to be. Peter, we saw, just to lend to this idea of the possibility for this blow off top to happen, Donald Trump and Jerome Powell, hand in hand, walked into the Federal Reserve, right? I mean, or wherever the heck they were. Let me just actually take a look at what they said. We'll see this together here. This is a nice clip from Fox.
I thought it was AI when I saw it.
Yeah, I thought it was AI. I thought it was AI this entire time, actually. I did not think this was real. Let's take a quick look at what Fox News has to say about this.
Trump took a guided tour of the Federal.
I always watch everything at 2x speed. Sorry, folks.
President Trump took a guided tour of the Federal Reserve today, the first visit to the central bank by a president in nearly 20 years. And during today's visit, President Trump confronted the Fed chair over the cost of an ongoing renovation project. Welcome, everyone, to The Four this afternoon. I'm Alex Savage.
And I'm Heather Holmes. President Trump's visit comes as he continues his aggressive push for the Fed to lower interest rates, with continued attacks on the Fed chair. Fox's Connor Hansen has more now on today's highly unusual visit.
President Trump paying a visit to the Federal Reserve Thursday. Trump and some of his allies have been critical of a $2.5 billion renovation to the building. Its initial cost was less than $2 billion.
Now 3.1.
I'm not aware of that.
Yeah, it just came out.
Arno said it about 3.1.
He has the letter in his pocket. I love it.
Yes. I don't know who does that.
You're including the Martin renovation. You just added. Yeah, you just added in a third building. Is what that is. That's a third building.
Well, no, but it's a building that's being built.
No, it was built 5 years ago. We finished Martin 5 years ago.
A lot of very expensive work. There's no question about it.
Fed Chair Jerome Powell.
I gotta say, what do I live in? What's this world I live in, where Donald Trump is walking around with the chairman? Have I ever seen this before? I've never seen this before. What are they doing at the Fed? He's pulling out papers from his pocket. I don't know. Is this what Rome felt like at the end? Is that what it felt like? I thought it was wonderful. Let's just continue listening to the rest of this.
Spoke to lawmakers in June about why the project was needed.
It was not really safe, and it was not waterproof and that kind of thing. So we took it on.
But the real elephant in the room has been the president's constant criticism of Powell, who has been reluctant to lower interest rates.
As a real estate developer, what would you do with a project manager who would be over budget?
Generally speaking, what would I do? I'd fire him.
Trump administration officials argue the U.S. economy is booming and lower rates would lower the cost of payments to the national debt.
Powell brought down interest rates during the Biden administration,
Right.
And then now you have he won't even bring it down when the economy is thriving.
They would also like to see lower rates free up the housing market. But Powell has cited uncertainty over Trump's tariffs as the main reason for holding back. Powell's term ends in May. Most believe it is unlikely he'll be removed before then.
There's nothing that tells me that he should step down right now. He's been a good public servant.
The Fed will hold its next meeting to discuss rates.
I miss Scott Bessent. I wish he was around more. I like everything that Scott Bessent says, because he must be a terrible poker player. It's just right on his face. It's like he just took a quick intensive class about lying over the last 4 months at the Learning Annex, and he is not good at it. But when he's telling the truth, he's like super telling the truth. And when he's lying, he might as well have an anime bead of sweat coming down the side of his face.
Next week in New York, Connor Hansen, Fox News.
Thank you,
for
Mr.
more
Hansen.
perspective here, let's.
All right. Well, you get the idea here.
Ventura's got something to say about this.
Yeah, let's hear it.
Ridiculous. He's just trying to get the rates he wants.
This is
I
what
don't know. Look, asking for the rates to be cut like that is guaranteeing that he's not going to get it. Part of me believes that he doesn't want rates cut because he's asking so forcefully.
I don't know. Donald Trump seems like the sort of like, he just says the thing that he wants and then he bulldozes it in order to happen. It's one thing to have like no tact when it comes to this sort of thing. He's not doing machinations from behind the scenes. He hasn't read 48 Laws of Power. He's not following any Machiavellian anything. But he also doesn't seem to take no for an answer. He's soon to be 3-time president Donald Trump. So we can't like just gainsay it. We'll go, oh, he's never to get it. He seems to like he's dragging Powell through the bowels of a building being built for a publicity tour just to give him a little public spankings. Like, yeah, I could drag you wherever.
But I'm
I
gonna.
want to.
So Jerome Powell can just come out and be like, okay, we changed our mind. Like, I don't get it. You got to give someone an out to save face for them to be able to make this deal. This is not the out of the deal. This is making it
Ken
impossible
Carson,
for Powell.
He talks about this idea that
just before you continue, can you because I just want the visual. Can you put it on a still with Donald Trump and and Jerome Powell, and then you can tell me what you think. Yeah, right there. It's good.
The back at the tariff drop that we had in April, end of March, April, where the markets came down because of tariffs. You'll remember we were talking about on After Hours this idea that, hey, he's going to have to engineer a crisis in order to get the Fed to cut rates. I mean, the Fed only cuts rates in a crisis, generally speaking. Especially Powell doesn't have a habit of cutting rates if there's not a big crisis, because he doesn't want to be seen as exacerbating the difference between, or the distance between, the haves and have-nots. So he doesn't want to cut rates, right? Now, he did keep rates at zero for a long period of time, but that was like the status quo. And he didn't want to raise rates afterwards in order to cause pain to the lower class and all that sort of thing. For better or for worse, he waits until something severe happens. Volmageddon in 2018, he did that. COVID, COVID-19, then he emergency cuts, even though China was showing, severe signs of problems since late fall. He doesn't like doing that. And he said that he would be cutting. Essentially, he's intimated that they would be cutting, but for the tariffs.
Right.
He remembers that the Fed didn't listen at the transitory inflation when there were supply shocks that happened during the lockdowns. They didn't anticipate that, and he doesn't know what these tariffs are going to do. It sounds like it'll still be a supply chain shock because Donald Trump is trying to onshore a bunch of manufacturing. So he doesn't want to sit there, cut rates, and then it causes inflation to go back up, and then they blame him for exacerbating it, or maybe even being the full cause of it. So, he's not eager for that to happen, both for the reputation of the Fed and maybe even like what could actually happen in the economy. So he keeps dragging this out, waiting for something to force his hand in order to do it, because central banks and governments want rates to be lower. They want to print money. That's what they want to be doing. Okay, so he has to put on a good show of resisting. He's got to put on a damn good show. And standing there getting a letter from Michael Scott, I read it and I go, this was a building that was built 5 years ago. Just shows like, I don't want to be here and I have to be here. So that means Donald Trump has major leverage on this guy. You don't know what kind of leverage he has on him, just political. And that eventually, once he's given enough, like my 3-year-old, once he protests enough, then he goes and does the thing. And he goes, look, what can I do? And people go, hey, what can you do? If Donald Trump was on my tail every day, all the time, maybe I'd eventually cave as well. So I look forward to that. The reason I like that is not because of the exacerbation between the distance between the rich and the poor, is that I like knowing what's going to happen. If you're a trader and you're in markets, you want to know what's going to happen. And both JP and DT want the stock market up and to the right. They want the bond market yields down. They want money to be flowing. They want credit to be issued. That's what they want. They both want it. None of them don't want that. They both want full employment. They both want stable prices. Both want higher markets. They both want sound collateral. They want the repo markets to work properly. They want the euro dollar system to work, and they want the dollar to be the hegemon of the planet. They want the same things. They're just like this married couple, and sometimes they have to like argue a bit in public in order just to feel like they're still their own person. You know what I mean?
So what's the trade?
Long liquidity. I don't know how many times I have to say this to people sometimes. Guys, S&P and NASDAQ.
Show the chart.
S&P and NASDAQ, all-time highs. All right? I don't know why we have to beat around the bush here. Buy and hold and sometimes short. That's the Mike Christensen way. That's what he taught me. The market goes up and to the right. The market goes up and to the right.
Load this before you keep talking. I want to see the chart.
Sorry. The market goes up and to the right. And if you ever doubt if the market's going to go up to the right, you zoom out a little bit more, and you'll notice that the market goes up and to the right. And if you ever doubt that, you zoom out even more, and you'll notice that the market goes up and to the right all the time until it doesn't, in which case you have bigger problems. Up and to the right. Let's take away volume. This, my friends, is your meme coin stock market. Okay? Hockey stick up. I don't know if people remember last year, Mike and I were talking about the idea. Where were we? We were in the depths. Yeah, 2022. We're talking about it. Actually, right around over here. And I was saying, I fully expect the stock market to be up more than 100% and just hockey stick up from where we are. And that it would be nosebleed compared to what we had before. This, my friends, are what we call a parabola. It's just getting steeper and steeper. And excuse me, what do you think is going to happen over here? That it's going to fall and we're going to stay down for the next 10 years? No, my friend. We are going to continue up. Okay? That's where we're headed towards. Now, we're going to have these dips. Right? These dips that you're seeing over here, these dips we're going to have. I get it. This is Volmageddon, COVID, inflation, and tariffs. All right? But do you see how the drop, okay, this is a bigger drop. This one didn't go as deep and went a little bit longer. This one was a wick. A wick. This lasted a month before we're headed back up to all-time highs. We're not getting these guys anymore. This whole global financial crisis, 10 years of nothing, .com, 10 years of nothing, we're done. We found a formula. The formula is print more cowbell. That's the trade. Trade is long America.
Long America. Okay, well, awesome.
All right. So let's just go ahead and before we actually jump to our next story, which will Ken Carson, who whenever he crawls out from his golden house, which he must live in, because if you could tell the future, of course, you'd imagine that you have all the things, and he's very good at describing the paths that the future can take. So much so that I suspect that he is from the future, and he's come back in order to guide us. He's one of many nodes, very Doctor Who-like characters, Time Lords, if you will, in order to help us get on the straight and narrow. But before we get to that, let's get a word from our overlords.
Ask yourself this. Are you making trading harder than it needs to be? If you're trading manually or still coding just to connect to your broker, yeah, it's time to upgrade. Traders Post lets you automate trades using signals from tools like TradingView or TrendSpider or even your own custom setup. It works with brokers like TradeStation, Tradeovate, Coinbase, and a bunch more. I've been using it myself, and getting started was smooth. The platform's clean, setup's quick, and once it's running, it just works. And when you're ready to scale, adding more strategies, plugging into prop firm accounts, or juggling multiple portfolios, Traders Post handles it. It's built to grow with you. Start your free trial at traderspost.io. Trade smarter, automate your edge.
because I think that Ken Carson and I could be best friends if we could only get him on the show. Hey, we're back. So let's take a look at Ken Carson from Kai Wealth, who is on StockTwits, which is fast becoming one of my favorite channels because or podcasts, because the two guys who run it, one guy knows like less than like most of the guests, and then the other guy knows even less than that. They also have a Peter, like an everyman, who's just like who's just there, and I love it. I love when it's like when it's two wonks talking to each other. You end up watching the video and you're googling constantly on the side. But when you have somebody's there, like, okay, you just said this word. Can you explain what this word is?
Yes,
super helpful.
Everybody needs a Peter.
Everyone needs a little Peter, exactly. A little tiny Peter, a little homunculus, I guess you might call yourself. You might not know that Peter is actually 3'7". All right. So Ken Carson was on StockTwits the other day, and you guys got to go take a look at this full video. Ken is getting much better at doing his bits and getting his ideas out and explaining himself. He's like really he's edging up to masterclass as far as speaker is concerned on these platforms. But this one is particularly good, the way that he explains things and the way that he touches on different ideas. We're only going to take a look at two clips on this. The first one has to do with the dispersion trade in the market. So just to set the scene here, they're sort of asking, the markets are at all-time highs, and it feels like everything is worse than ever. Eggs are still expensive. Millennials can't buy homes. Social unrest, political upheaval, wars all over. All-time highs. I guess he didn't watch earlier on in our show today where we said markets go up and to the right. I'm not sure why you think anything like that not going to happen, but markets go up and to the right. So let's take a look at what Ken has to say here.
There's no audio.
Oh, sorry.
Hey, what happened? What happened to you? Why'd you disappear? Does that mean?
I'm trying not to disappear. 1 second. I'm back.
You're back.
All right, here we go.
He truly did. Oh my God.
I mean, he did give everyone a nice tip. You have to give it to him.
You got to listen to the president of the United States when he says stuff like that.
Yeah.
Well,
they were just talking about how after the tariffs brought down the markets, and then Trump was like, okay, no, forget it. Psych. And the markets went back up. And it's like, they're like, you got to listen to when the president tells you what he's going to be doing, you can't just be like, I wonder if, let me read between the lines. No. Just turn your short over to a long and just write it up. No one's a better trader than the president. And we've never had the president like tell you what the trade is.
Now would be a great time to buy.
The market. You're like, what is happening? Is this what it feels like to be Nancy Pelosi? Just always knowing what to do? All right.
Had banks reporting earnings, strong earnings this week. Pretty much everybody. JP Morgan, Citigroup, Wells Fargo, Bank of America, Morgan Stanley, Goldman Sachs, all reported strong Q2 earnings. They had, no surprise, elevated trading revenues and robust consumer banking performance. I'm a robust consumer. I'm so robust. Yeah, I'm as robust as they come, actually. I'm robusting out of this damn shirt. But then we had an elevated CPI, which was surprising. And I would have thought that it would have caused a little bit of a drop. But lo and behold, doesn't matter. Inflation came in at 2.7%. And all the basic necessities, utility gas, car insurance, electricity, meat and eggs, car repair, homeowner, hospital services, rent, food away from home inflation, the old Taco Bell indicator, all up. What sense is there to make of that, Jim? That inflation's just the market just not give a crap anymore?
All-time highs will continue until morale improves. Okay? Just keep that in mind.
We've said this before. In the short term, markets are a voting machine. In the short term, all that matters is buyers versus sellers. And a lot of the structural things that drive buying and selling have nothing to do with logic. And actually, and we'll get to this, and I think in the words of George Costanza, if everything I've ever done wrong is I should maybe I should do the opposite. That's what I'm going to do. I'm going to do the opposite. And what happens during the summer of George is vol compression with little to no volume, a dispersion of the constituents of the index. And if you're going to push things away from each other and there's nothing going on, guess what's likely to happen? Those that are short are likely to have their shorts go higher, and those that are long are likely to see their longs go lower, and those that are long and short, like hedge funds, are likely to see both go in the opposite direction. It is a pain trade. And almost by definition, they are short things because they deserve to be short logically, and they are long things because they deserve to be long logically, yet they are all positioned logically in a way that is getting hurt. So the running of the memes happens in the summer. Retail wins, institutions lose, but not because retail is right, because the positioning at the institutional level is so big and there's so little volume, and dispersion pushes everything away from each other. So the answer, quite frankly, is to do the opposite, is to do the things that don't make sense, that are illogical, to fight the positioning, to squeeze the positioning. And again, positioning by definition is there because generally speaking, it makes sense. Ironically, that
I love that. I wish put all that on a t-shirt. I'm going to tattoo that on me like a memento, just to always remember this. It makes no difference what the narrative is in the short term. The narrative doesn't matter. If everybody is on one side of the boat, the market is designed to cause pain for those people. Being right, what should happen, has nothing to do with anything. It's all about position. And this is why in the Bitcoin discussion we had earlier, I always talk about this is where the levered long and levered shorts are. You're like, Tom, what about spot? Well, spot doesn't have to buy or sell, right? If you're buying spot, you can hold that position to zero. There's no problem. It's only your propensity to hold it that'll stop you. If you're long, you get to hold that however you want. But when you're levered, you're paying funding rates, you're paying margin fees, you have liquidation risks, you have path dependency. And so you become a forced buyer and forced seller, and it's the forced buyers and forced sellers that dramatically move a market, right? Think of, he's talking about positioning here, the running of the memes. He's calling back to GameStop, AMC. It didn't matter that GameStop was the company was failing, and video games weren't selling well, and the brick and mortar stores weren't good. It made no difference because the institutions were shorted, or the hedge funds were shorted. Retail traders were able to come in with enough positioning in order to drive a short squeeze, and this stuff is happening all over the place. The positioning. These things happen constantly. Now, it gets exacerbated, like you were just saying, in periods of low volume and vol compression, right? So when you are in periods, let's say in December and in so during Christmas, the holidays, and in the summer, more people are away, less people are trading, and you might be like, oh, things are happening automatically. No. Technically less people are trading, less volume is happening within the market. So you have less volume, which means that it takes less in order to move an asset because there's less volume there. But you also have vol compression. So when you're headed into these areas, as volatility is falling down, people are selling volatility. They're selling options. They're selling puts and selling calls because because the market is sort of like staying steady, they're just grinding steadily higher. If that's what you're looking for, it's grinding steadily higher. Then you can sell calls and sell puts, insurance to the market, as you're collecting that premium as it goes. So you're just making money. Well, what happens if you now own that risk? If you own that risk and then the market moves significantly up or significantly down, you as the person who owns that volatility, you have an incentive to make the market go the opposite direction. So if it goes up, you want to short it so that to bring the price of the market back down, and if it goes down, you want to buy it in order to bring the price back up. So you end up in this. You just stay in this area. And what does that do? That causes the low volatility that caused people to sell these players to sell that volatility to begin with. That volatility narrows even more because they've lowered the volatility by pinning the markets, and so they could sell more and more and more and more, and then you end up in a situation where you can have blow-offs that happen because more and more people are positioned short. More and more people go, well, this doesn't make sense that we're this high. Like, narratively, it doesn't make any sense. We should be positioned short. We will be having a recession. Clearly, that's going to happen. It doesn't matter that the powers that be are saying this is the strongest economy we've ever heard. Yeah, they said that like two weeks before COVID. It doesn't matter. All that matters is what's actually happening in the economy. And he just named inflation is up, and fees are up, and all these expenses are up, but still the market is making all-time highs. And so the large players are positioned short, rightfully. But it don't matter because if the market keeps moving up, they're going to get short squeezed. You can't hold these positions they're levered. They can't hold these positions forever. Then they get cleared out, and if they get cleared out, that's where you get a blow off top, and then you roll over. Then you fall lower down. So when we take a look at the chart for, let me just pull it up a second here. If you take a look at the chart of S&P, you see that before the drop happens, it's a peak. It drops, and there's a peak, then a drop, a peaking, then a drop, a peaking, then a drop. This hardly ever happens where it goes up and peters over sideways and then falls. That's not generally what happens. Generally speaking, what we get is all-time highs, then fall. All-time highs, then fall. All right? So that's what I'm expecting to keep happening here. And we're month after month on the S&P, and it's been 3 months in a row, green candles, super strong, stepping up. All right, let's finish off the last segment for Ken Carson. Again, you guys definitely want to go check out the full video.
Are you going to be sharing that?
Yeah, I'll put that inside of the description, and I'll also I might share a clip on it on the Trader.
Post it as a comment, not description.
Sorry, yes, I'll post that as a comment for you guys to go take a look at. All right, so let's just jump here. Well, we talked about the dispersion last time. I don't want to belabor the point on that. You guys could take a look at the office hours videos from last week. But essentially, the idea is that what's being pinned, that what I just described as being pinned, and again, this comes from Ken Carson, is the index, the S&P, the NASDAQ, Russell, that sort of thing. That's what's being pinned because that's where people are buying and selling the options on the index names, on the index themselves. But the constituents of the index, the Microsofts, the NVIDIA, the Amazon, the Facebooks, those stocks can still move dramatically. It's just that if NVIDIA moves up dramatically, something else has to move down.
Right.
And so you have the volatility, but in the single names, which means that if you're trading, if you're a systematic trader, you're a discretionary trader, you're an automated trader, the idea is that maybe you might take a look at your stats. Maybe you should let some of your winners run more on the single names because they're more likely to go further than you think, either up or down. Because as they move, participants are forced to sell or buy it, right? If NVIDIA goes from 1% of the index to 2% of the index, everyone who buys that index has to buy more NVIDIA, and they have to sell something else. They're forced buyers and sellers. There's no choice. That's where positioning comes into play. Super useful. All right, let's hear his predictions. We're going to hear the start of his predictions for what he think might happen over the next couple of quarters.
We'll start from long term to short term because it's kind of the more logical kind of progression here. We know that on all these measures of whether or not it's worth it for institutions to own equities and to own bonds, to be 60-40 allocated, to buy assets, that we are at or near historic valuations. Okay, so let's start there. We know that at the same time that the releveraging, the amount of money that was created in 2021 that drove a lot of this investment, right? Its peak of reissuance of debt and all these other things happened in 2021. The amount of reinvestment, so as debt rolls off, you either have to get new debt or you have to liquidate the asset that you bought with that debt. Right? Those are your two options at that point. And the rates that people got, think about 1.5% back then, are now 5%, 5.5%, 6%, maybe 7%, some mortgage, right? And the reality is that money has to be, people have to make that decision. There's a massive amount of reissuance that needs to happen in order to meet that. And when everybody needs to go get a mortgage or a loan or whatever, that is liquidity coming out of the system. You know, you have cash, which is money, and you have debt, which is money. Debt has an expiration date. When that debt expires, that liquidity comes out of the world. You either have to sell the asset, right? Or you got to go get you need to spend money to go get a new bond. And now the cost of that has gone way up. And it's not just bonds, it's venture capital, it's all the things, right? Like SPACs were a great example, right? All the venture capital, companies raised dramatic amount of money back then. So that money is coming due. And the average duration of that debt, and that is 5 to 7 years. And that venture capital money is 5 to 7 years. That puts.
This is what I love about Ken, how he explains so clearly the dynamics of what's happening there. You borrow money. Any of the institutions are buying money, or people are buying, taking out debt. That debt is expiration. There's an expiration date. You have to pay back that debt. It's not like cash. That's a bond of infinite maturity with 0% interest rate. There's an end to it. And because you know when the people refinanced, if they have a 5-year bond, you know that technically speaking, between 3 and 7 years, they're going to have to be refinancing then, which he says you can tell money's going to be pulling out of the system. So what happens if liquidity is down? Assets go down. There's like no real way around that. They have to sell the asset. So what are you going to do? If you sell the home, they're going to sell the stocks. They're going to have to sell it, or they're going to have to find some way of refinancing. So unless interest rates come down dramatically, to the point where it makes sense for the borrower to refinance their debt, if that happens, great. Then music shares keep going. Let the music keep dancing. But otherwise, we go down until the risk is all cleared out, and we could start that process of rebuilding debt again. Let's just continue another minute here.
This is at 2026, right, to 2028 as the peak, and it's already starting, right? So all of that money, these are the things we know, right? Has to be pulled off, and this is why Trump is talking about Powell constantly. He's obsessed about it. That's why best let him keep talking about the 10-year. At the end of the day, that liquidity and where it stands now, if it just stays there, and by the way, if markets are supply and demand, if everybody needs to come essentially, get more debt, what do you think is going to happen to the price of that debt? Right? If everybody needs to get through the same door at the same time, there's not a lot of liquidity. Yeah, yields are going to fucking go higher, right? So this is a problem. This is a problem for the market. It's a problem for Trump. And by the way, Trump has midterms coming up in 2 years. Right? His popularity is already not so great because of some of these things. So he has a dance to do. The politicians always have to do a dance. And the timing of that dance is very important. Yeah, they got to do the dance. I need my shoulder pads.
His one.
All right. And then he goes on to talk about the timing of that has to do with the election cycle, not just of the presidential election cycle, but the midterms. And that even though Trump is not headed off to a third term, may his name always be praised. It can be. He does need to have the party win, and so he will have an incentive in order to goose markets. That could be now, or it could be next year. But he's got to. You can have a down year, you can have a down quarter or whatever, but then you got to pick it back up. Because people have short memories, and if the stock market's at all-time highs when it's happening, great, and if it's not, problem. So he's trying. It seems like he's trying to engineer recessions, trying to engineer not recessions, but like for the Fed to cut interest rates. He desperately wants that to happen. The guy is basically walking hand in hand with Jerome Powell through construction buildings to the point of like, I got to get these rates down. So bet on however you want to bet, but keep an eye out towards these liquidity trends, because one, it can make outstanding moves if you're an intraday trader, just massive moves if you're timing that at the right time where one of these events happens. Or if you are systematic long term, think in terms of positioning, think in terms of liquidity, and not so much in terms of narrative. Because if you do narrative, you might be right, but wrong the entire way. We're here to make money. Because as traders, we don't just listen to the news, we trade it. Peter, that's it for us today for After Hours. It's been fun as always. I like it much better when you say less. I gotta say,
I've been practicing.
It's fun. It's great. Makes me feel more like how our life was supposed to be. I don't know. Just feels that way.
All right.
Hope you guys like it. If there's any news that you guys saw that we didn't call out, please go ahead. Tell me what's been rocking your market over the last week. Post it in the comments. Post it online. Always happy to hear about it. We read everything, every single thing we read, and it's very fun. Thank you.
I know a little piece of news that you didn't talk about.
What did I talk about?
That you didn't talk about. A rumor or something.
What?
Something that Trump said that he wants to get rid of capital gains tax on home sales or something like that. Basically, he's trying to. I heard they're trying to incentivize, since the rates are not going down, to try to incentivize people to be able to sell by removing capital gains tax on a sale of homes at some threshold amount.
Is that why people aren't selling? I thought the reason they're not selling is because they would have to go rent afterwards or buy a smaller place, and the costs are so high they would actually end up just wasting a bunch of money getting a place that costs just as much or renting.
I think it's a combination. Well,
the people who own the homes have no incentive to sell these homes.
That's why they're trying to create that. Like, I heard him say it, and it sounded like he was just kind of like floating it, but I thought it was a kind of an interesting thing to bring up.
What is it right now? I think they were talking about in this video, 49% of the U.S. electorate are now invested in markets, financial markets, which is up 10% over the last 10 years, 20 years, something like that. The highest it's been on record. It's all about stock market now, folks. The whole idea of millennials having homes and guy, it's done. It's over. It's 401ks and crypto and markets go up, man. Just get all that other stuff, all that old school 40-year-old thing or whatever, boomer, even X generation, that stuff is gone. They own the land. The boomers own the houses. They ain't selling it. You'll get it at the estate sale or whatever the hell it is. You ain't getting a home. That's not happening. That's not in the books. That's not what's going on. All these institutions want to buy up the homes and rent it to you. Get used to renting. Get yourself in your side gigs. Get your AI. Learn how to trade and transition to the new golden age of the first turning. It's hard being right all the time. It's hard.
All right. Okay.
All right. It's been fun. Thanks, guys. We'll be back next Friday.